right? You need to take a risk. You need to take that first step, not the investor take the first step. One mistake people always make is actually they look at the historical market size.
It's better to have the right strategy and raise money than have a product and raise money. Are you trying to challenge them?
We always do.
Yeah.
Always do, and see how they actually respond to tough questions. TSV were famous for was funding Zoom as a first investor. We put $250K in Zoom when they were like 2 or 3 people shop, right? Out of a garage.
Hi everyone, my name is Vasildav. This is Raisable Founders Hub, where we turn entrepreneurs into founders that are capable to raise capital, attract best talents, and build global companies. And our today's guest is Lisheng Wang. Lisheng is seasoned venture capitalist here from Silicon Valley. He is an advisor at the well-known accelerators like Techstars, Berkeley, Skydeck. I was really impressed by the number of investments he has made so far. I also found about at least 3 exits from his portfolio companies. I'm super excited to start this conversation, but before we start, just a brief reminder, don't forget to subscribe to my channel, like this video, and give us a feedback or ask questions in the comment section to this video. Hi Lisheng.
Hello Vasil, very nice to meet you.
Thank you very much for joining us, really appreciate your time. Can you tell me, what are your main roles right now?
Well, there are clearly a number of things that we do. First of all, I'm a partner at the TSV Cap. TSV Cap is basically a Silicon Valley-based venture capital firm. We focus on early stage deep tech, health tech, and data economy-based companies. We're actively investing out of Fund 5. We are probably best known for backing companies like Zoom, Carta, Ginkgo Bioworks, OpenTrons from the very early days. We're typically the first check going into these companies, raising institutional rounds, and really happy to supporting these companies. We also have a focus on immigrant founders, which is probably catered towards your audience as well. As you can see, I'm a first-gen immigrant, and other partners started their own companies. And so we have gone through that kind of change from someone who comes from a different country to study here and then start company here. And we actually can relate to immigrant founders very, very well, and we can share a lot of valuable lessons to them as well.
Yeah, actually, we were introduced by Professor Chuck Easley from Stanford University after our conversation on investment into immigrant founders. And can you share how many companies have you invested so far through your fund as an angel investor, and how many of them are companies that are founded by immigrant founders?
Immigrant founder, of course, America is actually a country of immigrants. So immigrant founders or innovators is a huge part of the success of this country. I think probably 45% of all the Fortune 500 companies were either led or founded by first-gen or children of the first-gen immigrants, right? And 44% of the unicorns or the companies that valued $1 billion above were started by immigrant founders. So there's actually a proved track record of immigrant founders being great founders to create value for investors and the society as a whole. As TSVC goes, we have so far invested about, I think more than 200 companies across 5 funds and continue counting, right? And I think about 70% of our companies, portfolio company, were started by at least one immigrant founders, being in Chinese or Canadian, Israeli, Indian, and so on and so forth. A lot of Europeans founders as well. And so we love to found these companies because, first of all, they all come from very strong academic background typically, right? Because we fund deep tech. Second of all, they're very eager. They work super, super hard as well. And financially, I think that they're also very responsible. There's a lot of research shows that immigrant founders raise less money and to achieve more, let's revenue or profitability. So that's actually great traits that, one of the basis that why we want to fund immigrant founders. And personally, my previous experience was actually the founder and, basically a chief operating officer of a platform called PropelX, which is actually an investment platform for deep tech companies and deep tech related funds as well. So during that process, and also I started MIT Alumni Angel Group as a co-founder and co-director back in 2012, 13 period. So during 2012 all the way to me joining TSVC in 2022, I think I probably looked into, I would say, close to 1,000 companies. We invested or put the companies on our platform, Propellex, or the MIT Angel Group. I would say about 200 plus companies as well. I think we eventually funded more than 150 rounds of financing.
Wow, that's impressive knowledge, impressive numbers. You should have learned a lot of regularities or patterns. Can you tell me what are your criteria that you look into the founder right now?
That's a great question, right? Early stage investing, honestly, is all about the founders, right? And people typically rank founders, product, market, right? These are three top risks when looking into funding a company. So in early stage, my personal criteria is founder first, product second, and market third. And people always go, why market third, right? Because the legendary founders and great founders always expand the market. They expand the market beyond your imagination, right? So the one mistake people always make is actually they look at the historical market size. They say the market is too small. But you find a founder and that dig into that market, they can eventually always expand that market to be a good investment opportunity. So that's why founder is always first. I think in terms of fundable, right, to your topic of discussion, what are the fundable founders? First of all, I think founder needs to at least take a risk, right? Many of founders, especially I think, in the Bay Area, in areas where you have a lot of big tech companies, you do actually see sometimes the founders would start raising funding while they were still at that post. They're still making $300,000, $500,000, and at the same time they're raising funding. And typically the first question I have is, well, if you're not believing in what you do, you need someone to give you the funding to jump into doing entrepreneurship. You sure this is what you want to do, right? Because you can convince yourself to do it. If you don't take the risk, or do you really expect other people to take risk, right? So, I mean, there are people who are willing to fund, entrepreneurs like that. But I think, TSV, CAP, or me personally, typically kind of try to shy away from these type of founders because you want them to think bold and to be convinced that their idea is a good idea. If you're not convinced, you don't take the risk. I think it's tough for other people to take the risk with you. And the second thing is actually the founders do have to have very clear idea what they want to do, right? So early stage products do change and company do pivot. Anytime you want to jump into doing something, we expect the founders have done enough research and diligence. They know what they're getting into. They can talk very knowledgeably about something. Instead of, I want to do a company just because someone else has done a company. And they make it very big. So I'm not worse off than them. I should do a company equally big. So that's the worst kind of beginning of a startup because you don't have the pain point that you're trying to address. You don't have that personal touch, right? And that's really painful. I want to solve that. So on the contrary, we're always looking for founders with that kind of ambition. They know something, they feel something that's really bad and they want to solve it, right? And they can't wait for other people to solve it and they need to solve it themselves, right? So one of the examples that TSV kind of were famous for was funding Zoom as a first investor. We put $250K in Zoom when they were like a 2 or 3 people shop, right, out of a garage. One of the reasons was because Eric couldn't wait for other people to solve, the quality of the voice. Or, at the time we were using WebEx or Skype, I believe, right? But oftentimes there was quality issues with the voice, right? And also the video. And sometimes it can't hold, even the reception was pretty strong, right? So he couldn't bear that kind of quality issue. And he proposed these ideas within the big organization of Cisco. Cisco acquired WebEx, right? But clearly when there was a monopoly or duopoly, there's very little effort or incentive to change the status quo, right? Because no one else to challenge you. He just couldn't, he couldn't actually kind of bear the quality. As an engineer, as a product guy, he's like, I need to build something better. And one of the story was actually there was a big bonus, right? He's a high senior executive at the Cisco when they acquired the WebEx. She's really high up there. And there was a bonus on the table. Now, in the next couple of weeks, he could get it. But he couldn't wait. He just, forget about it. We talked about it. Well, there's this bonus, we waited a month or two and then can get it. It's a fat bonus. And he said, well, I can't wait. I have to jump into it. So that tells you how convinced he is, how committed he is to his idea, right? Without people funding you, without even thinking about it, I want, because he can basically take that bonus and fund himself, right? But he said, well, I can't wait, I want to jump in, and are you with me or not, right? So I think you wanted to look for that kind of founder, really want to solve a problem, and they feel so painful about, right? And also want to take a risk, right? You need to take a risk. You need to take that first step, not the investor take the first step. Does that make sense?
Yeah, definitely.
Right. Finally, I think communication. If you're knowledgeable about what you do, you clearly have a vision what you do. I mean, you should be able to communicate that idea to, let's say, investors, also team members, right? Oftentimes, we do see founders come to us, and for a large check, we say, well, how do you intend to use that check? Their idea is like, well, I need to hire this and that engineer. I said, why do you need that much money for a hired engineer? Oh, he said, well, the market price is high, and therefore I need this money just to hire these people. Then the question being, well, can you really sell your idea to your future team member? Do you have to give them a competitive salary to hire them away from where they work at, right? If that's the case, what if someone else gives them a larger check? Can you retain these people? Or you continue to need to raise funding to keep these people, right? So one test we have is actually, we want to see founders who are able to convince future employees or their customers with not a whole lot to show for. But you can convince them not taking $1 million check or a $500,000 check from the big techs, but willing to take $100K, $200K to work for you. And that's what we're looking for. So when you have that fundraising amount, you better not put them $500,000 to hire someone, because that means you cannot articulate your vision. You cannot convince or sell your idea to people who are really strong technically and who can build a product for you.
Yeah, definitely agree. And so when it comes to the product stage, so you mentioned main qualities of the founder. And I also always bring the attention to the idea that it's better to have the right strategy and raise money than have a product and raise money. Because when you speak with investors and you have a product, that presentations usually starts with look what I have built, look how great it is, instead of I want to listen about the problem, about the market research, about the insights you have on the market, and what actually problem you are going to solve. But at some point, some investors are fine to invest having the right founder with the right background and the right strategy. And some of them still would like to have MVP and some product. What about your fund, and what do you think about that?
Yeah, honestly, it has a lot to do with the founder again. I would say there are two types of founders. One type is actually, they do listen to customers very attentively, and they solve their pain point, right? And the initial product they build might not be the best product, then continue to improve, and they roll out the product and listen to the customer, and they refine the product. Honestly, we always want hopefully the founders, the right founders, would actually do enough user research even before you have a product, right? So I think coding something simple as an MVP is not as hard. So you can actually roll something out very, very briefly with a small group of people to see how they feel, right? We want to have the founders at least to think through, right? It might not be right at that point. You might still have to pivot, but it's hard to have a founder come to you without clear articulation of what they try to solve and what pinpoint value they're trying to solve or create. So and that's first, and hopefully before even roll out the product, you already have some good idea from the customers. What type of product, what type of pain point they're trying to address. That's why I told you that we do like to fund kind of founders at least have the personal touch of that problem, right? So meaning that they can clearly feel the pain and that the users are feeling. And they're probably using the product, they don't like it, but they have to use it because no competitors. And now they have to jump in to solve that problem. So that's the best founder do you like, because there's no lack of market demand. The market is already there. And just the current product is not that great. And you have way better ideas to solve it, right? And the other type of founder, it's art than science to tell them apart. But sometimes you do see founders that have a clear vision on a product. The product might be a little bit early, today. And you don't know where that leads. I mean, some of the best companies were built by that type of founder. Very controversial, kind of crazy. They come to you with an idea, like Airbnb, or even the Apple iPhone. They come to you with an idea. Of course, Steve Jobs doesn't have to come to us for the idea, but what I'm saying is actually they have an idea, right? And they say, well, somehow they see that in 10 years, that's going to be mainstream. No one else sees that. And they actually kind of start building that product. Those founders are far and few in between. And so majority of founders and great founders will still fall into the previous category where they just very methodically due diligence a problem. They know what that is. They know how to solve that issue. They start build. So we tend to kind of, we see more founders in that category, and we're trying to back these founders. And the crazy ideas, once in a while, I think in a portfolio, you might want to have a few crazy ideas and people who telling you ideas that you just don't know if it's gonna happen right away. But because the founder is so impressive. And typically, these founders typically builds the biggest companies out there. You might not believe it today. And also for investor perspective, you typically get the best returns out of these investments because when you invest, no one believes in their valuation is low, right? And they continue to prove you wrong. And you're the only kind of investor in that company, you can get sizable chunk of the company as well. So ideally, you want to bet these founders, but these founders are very far and few in between. So there are more founders that have some experience and at least personal, I wouldn't say experience. I wouldn't say someone necessarily needs to be able to had experience to build a software before, but he or she feels that pain. She has a personal touch to that rather than, I just want to start a company. So I think that second category, the founders takes a lot of user kind of input. And also he, her, or herself better to be a user and to feel that pain. And we like these founders as well.
Yeah, I remember one of my friends, he worked for large big tech company, and once he was looking for a job, and he told me about the conversation he had about his potential founder, and he told me like he is crazy enough to build that what he was talking about, and I was like, oh my gosh, this is so much about Bay Area. And this is actually what makes different entrepreneurs here in Bay Area, because we see so many crazy people building actually unicorns, and our brain is like, okay, this is realistic. This is actually the way to build a unicorn, disrupt some industry. But for many entrepreneurs that are not here, sometimes they call it that you are too romantic, guys. What you think about, it's I'm not sure you're really working on that, because it sounds so weird, even crazy sometimes for them. And so I told you I'm a little bit into the neuroscience field, so I understood that our brain see a lot of examples, and actually any education, even at Stanford, based on the use cases. So when we see a lot of use cases, when we spend time around such people, for us it's totally fine. And this is the gap what I see right now. And what are your ideas? What are the main challenges for the immigrant founders, like maybe next generation of founders that are going to come to Bay Area, how to adapt into Silicon Valley more quickly, I could say?
First of all, find your community. Find your group, right? So you're doing a great thing here, and you have this community, and you can actually convey these ideas or best practices, right, for founders to get funded here in the Valley. And that's first, find your people and understand how they actually gone through that personally, because you can learn a lot from fellow founders who have done that before, like who have walked the path you are going to walk, right? They had come out somehow very positively, and they did their company, they raised their funding. Learn from these people, right? Because it's very hard, without knowing something about the place, it's very hard to immediately kind of plug yourself in and get the best results of it. So I would say, building this community that, as you do, is very beneficial for founders. The other thing is actually, I think also seek out maybe investors who come from a similar background as well, right? People who become investors because either they start a company as an immigrant founder before, oh, maybe they came over here for graduate school or for undergrad as an immigrant. They went through that process. It's probably easier for them to understand what you're going through, right? I also would say that the rate of investing in immigrant founders have definitely picked up, because more and more research shows that immigrant founders are very fundable compared to, let's say, the mainstream founders, majority founders. And I think now people understand that at least we can get equal number of or percentage of good companies out of this group as well. So I think there's not necessarily a shortage of investors. It's really that some funds like TSVC, we actually kind of place very special focus on immigrant founders because we come from the same background and also develop programs to help them. For example, hiring people, how to communicate with investors, things like that. Because oftentimes, as immigrants, we do have, let's say, accent. We do have different cultural background, and sometimes you carry a small conversation you might have different kind of opinions or ways that you express yourself than, let's say, typical American people. So that sometimes could actually lead into a kind of a not so positive experience, right? But how do you actually turn that around? How do you actually make that useful experience for yourself and for your fundraising purposes or for your customer discovery purposes? And those are the things that we try to share. And also, we do have a large immigrant founder portfolio. So some of the successful portfolio companies, for example, right, talked about Zoom, Carter, all these people, Ginkgo Bio, they can actually share their playbook. As immigrant founders, how do we actually build these companies? What kind of difficulty we have to go through to build our companies as immigrant founders? I wouldn't say, actually Carter is not necessarily a good example because I don't think Henry is an immigrant founder. He might have some, non-Caucasian blood, but I don't think that he's an immigrant founder. But every single else companies that I think we have funded and that either a unicorn or have gone public, started by at least one immigrant founders, right? So these people actually typically would be able to share their playbook, how they actually build a company, what kind of difficulty they have to go through, right? So I think find your people, find the right type of investors, entrepreneurs that you could socialize with. And finally, I would say to build a company in the United States or to at least to serve the markets here, and you have to also work with diverse group of people as well, right? I mean, work with people here, work with I think investors here. I think, as I said, that more and more investors realize that this group, immigrant founders, are really a fundable group. So you shouldn't be actually finding it super hard to find investors who are willing to take a bet in this group.
What else are the main challenges for the immigrant founders when they start building actually business here in the US?
This might be, I don't know, the different kind of minority groups or immigrant groups might have different traits, right? But
yeah, definitely.
One thing that we see is actually, I think here in America, I think there's a lot of teamwork, meaning that people build value through working with each other. I think there's from some immigrant groups, you do have like one founders that typically have a huge control of the company. And then the other co-founders, they call co-founders, but like a small minorities. And this typically starts because there's not enough trust. We weren't brought up that way to trust each other to build the kind of team. Therefore, this one founder is actually stronger than a collective voice of everyone else in the company, and he or she holds the majority of the company. That typically isn't going to work really, really well in the United States because we do realize as a society here the diversity, the power of diversity, right? You have people who contribute from different areas. And one problem that we do see some of the immigrant founders is that, well, they think that they are strong in every aspect. They have to be strong because they don't trust other people. It's not they cannot hire the high quality people, but even they hire, they don't trust them. So that becomes a problem. You don't give enough incentive to these people, the good hires, and they walk away eventually, right? And also they're not incentivized enough to perform the best. So these are the things that it could happen from people from a different culture, and that actually has to do with a lot of like how do you build a team, how do you share equity, how do you incentivize people, how do you build the culture very early days in a company. These are the things that typically would say a little bit lacking from people who are I would say entirely come out of different kind of territory area or regions. But for more and more people, I think if they educate here and they have a little bit experience with, I think, tech companies here in the Valley, and they start to realize that, I think it's not that hard to change that mindset. But for, I think, people who are entirely new to a company, I think that's something that sometimes you have to adjust.
Let's move about the smart money and what value investors bring to founders. So as I see things, I think it's very important to raise money from the investors that have background and experience in the field that you are going to build a company, because it's not only about raising money, it's about actually building a unicorn, building a business. So you don't need to raise money for something that will not work. And I see smart investor is someone who is also a validator of your strategy. And the value of the money is always much more higher if your investor has experience, if your investor has a network in this field, can introduce you to others. What else? Can you tell me a little bit more about how do you help your portfolio companies when you work with them?
Yeah, I think because most of our investments have this deep tech component to it, right? Being cybersecurity or AI chips, computation, and things like that. I think there is a clear value that we bring in terms of understanding technology and help them to refine their technology, right? So that is actually the key component as early stage founder we bring in, is to validate, as you said, that technology. And then I think it's also hard to actually hire people, especially in Silicon Valley where people are really well paid. How do you actually kind of hire them away from really well paid and cushy jobs? And that's another challenge, right? So being a VC firm with more than 200 companies, and many of them are actually very successful, either went through the IPO process or being acquired or now valued more than $1 billion. And there are oftentimes these circulation of talents that you can actually leverage. For example, we did actually invest in the first engineer come out of Zoom, right? And that's because of Zoom investment. And we also invest in people who spin off from other companies, that breakout companies that we funded. And sometimes these people will actually leave the previous company for various reasons, for personal reasons, or thinking about starting something on their own. And that might not fly, right, sometimes, and otherwise interested in working with other founders. So we did actually oftentimes bring these talents that we know are sometimes not necessarily involved in anything, or sometimes they're involved in the previous company, but otherwise are thinking about moving on. So we connect these dots to help newly funded companies or companies in need for talents. So that circulation or a talent flywheel is something that I think as a 15-year-old VC fund with multiple successes kind of enjoy. And also I think strategic help. So the early stage deep tech companies especially, because they're not like software company where you can ship products quickly, and you do have to spend time and capital to build product over time, right? And you have to have multiple testing points or pilots with customers. How do you actually convince a Fortune 500 company to come in and to work with you, right? And work with someone who actually has no reputation or whatever history. And that is actually a big risk they're taking. So having introduction from someone who have brought successful company to you before and have that trust helps a lot when we bring a new name to the strategics. And they actually are willing to kind of quickly to start pilot with them. So those are the value we bring. But I would say most importantly, I think technical talent is something that I think we're really proud of. Because with a lot of the companies that we invested in, we typically, when people ask why did you guys invest in Zoom, rather than the founder, but also we tested the codec, right? We tested the software which algorithm uses to compress and decompress the audio and video. And we did test that, and we actually kind of have the benchmark numbers to say that this is actually one of the best and is also automatically better than the competitors, right? So when you understand the technology, and you can really understand where this can be used. And so oftentimes we help our early stage company to understand, well, maybe you're starting this market this way, but have you thought about adjacent market where you can actually apply this to as well? Many times they haven't thought about it, right? So that's how you actually kind of create value for the company in early days. And oftentimes that helps them fundraising as well, because now you're talking about much more holistic kind of product suite than just one trick pony. Oh, I have this product, right? So those are, I think, important values that we bring to the company.
So you actually help them to do sales with the large companies, to do deals?
Yeah, I wouldn't say sales, right? Because eventually, I think at the sales, you have to close, no matter what kind of introduction you make, a founder have to close the sales. Either you introduce the investor, right? I introduce the sale, I say, well, I mean, this is a company you should look into. It's them. They have to close the deal.
Yeah, definitely.
Right. And then if I introduce, like, say, a Bosch or a TDK into a company that sells, let's say, robotic systems or automobile systems, and they have to tell they have to showcase what their product is, and they have to convince them that brings enough value to them. But at least we can connect them so the strategics or investor will at least listen very carefully. Because we talked about before this podcast that how valuable VCs or people's time here in the Silicon Valley. How do you even pay attention to your product, your deck? And that's actually a big test. Right, so I think that's where we can bring the value is actually if we present a deck, we present a product to someone and they're going to listen. They're going to say, well, let's invite them in and for the founder to close that deal.
Yeah, and it's actually how the money you invest more valuable. So because if they would like to hire you and just to have your consultancy in order to help them connect with others, consult how should they negotiate in order to make this deal happen. So they should pay a lot of money for the guys like you here based in Silicon Valley with all of your background and experience that you have invested your own time and money. And so when you invest and you provide this with the capital you invested, I think we should have this in the agreement, like the value, so more founders will understand that.
Yeah. Well, but honestly, we have the incentive to do that, right? Because we invest money. As you said, we have our skin in the game, so people were more likely to listen to us, right? Oh, you guys know what you're doing. You're always invested. Therefore, there must be something good about this company. But at the same time, because we invested, we want to work our investment as well. Not only just because we like the founder, we want to work, for him, right? But also we want to work for the investment we made. We wanted the investment to become even bigger. Let's say it's a good company. We wanted it to be a better company because our investment will actually appreciate more, right? So it's actually a win-win situation. Honestly, as you said, that money becomes commoditized. How do you actually stand out as a good investor and good VC fund? And sometimes it's also because the value you bring, and that actually help the company to get better. And then when they succeed and they come back to fund your company or to bring more deals to you, and that flywheel is something that we're looking for. And we have kind of, after 4 or 5 funds, you start to see that flywheel as well. We're super happy about that.
Very interesting. So you see as the founder that you are going to invest, will he be able to bring you additional deals later, good deals?
I have to say personally, I don't speak for the fund, but personally I've seen actually the best deals out of the founders' referrals, not necessarily the VC's referrals, because I think they don't necessarily have a self-interest in introducing other founders. And good founders tend to hang out with good founders. And you feel like sometimes good founders don't want to waste time on social founders. They want to socialize with the best founders because they can learn from each other. And the good founders do bring good founders. It's very interesting. And also when a VC refer a deal to you, unless you're longtime partners, like a co-invest and sitting on boards together, otherwise sometimes you will think, well, it seems like you do have the funding to fund the rest of the round, and you want to introduce us. Is that you wanted us to verify the idea? Or, I mean, is that really a strong deal, right? So I feel like the founder doesn't necessarily have that kind of incentive to bring you something that's not necessarily great, or they just introduce you because they like the human being. And that typically is a very strong signal of a good founder, because they're good founders that we trust.
Yeah, so the first line of the due diligence is made by founders.
Made by good founders.
By good founders, yeah. Many people who come to Bay Area, they sometimes reach out to me and say, hey, you raised this millions for this company, introduce me to the investors, And so usually the majority of them you can't introduce because it can be like the last introduction you made to the investors. So this also very important point that when the other founder makes an introduction for someone, he actually is also on his responsibility. Who is he introducing?
That's exactly right. Sometimes I think some founders, they know that the other founder he was introducing to us not that great. He would actually send a separate message saying that I just got to know this person. I don't know that person really well. So I think a good founders will tell you. And sometimes you see in their tones of the email or whatever phone call, they're so enthusiastic about someone. And that tells you that's a strong signal you should talk to the founder.
Can you walk us through your investment committee and how do you negotiate on who is the good deal? What is a good deal?
We do have an interesting, I would say, partner meeting where other than the general partners in the fund, we also have a lot of venture partners that we invited to the meeting as well. Because our venture partners not only deal sourcing, they are all seasoned entrepreneurs who have built great companies in the past, and also people who are senior executive of successful technology companies. And we also listen to their ideas as well. So as you can imagine that when you have a deal meeting with multiple people on the same deal, there's a lot of discussion. There's a lot of fairly heated argument as well. But we all regard that as a very, very healthy arguments because the person who actually typically push for the deal always have this innate kind of bias. Oh, this is a great company. Even no matter how thorough the diligence she or he had done, but there's always this kind of clear bias towards the company. Then at that point, you want other people to come in, right? And to actually push back from other angles. And we do actually have quite often. So we do have the weekly deal meeting, and that typically lasts for, I would say we talk about maybe 5-6 companies in total, but that meeting can last for 3 hours just because oftentimes we need to get to the decision. And oftentimes there are a lot of this heated arguments from different angles. Oh, have you thought about this and that?
So sorry, 3 hours for
a few deals, yeah.
For few deals.
A few companies that where you need to make a decision on.
And how many people involved usually in such conversations?
I would say regularly we probably have like 5-6 people involved, but then sometimes we do have, when we have more venture partners involved, I would say probably it can get to 10 people to talk. Not everyone is involved in the same deal, but people are talking about various deals, and each deal may have 4 or 5 people to comment on a deal, right? And so that has enough diversity of opinions and ideas. Everyone has come to the meeting reading everything they can read about this deal, but oftentimes still you have a lot of different ideas. And so end of the day, a deal gets through the IC, has been poked around from all angles, 360 degrees. The customer, have you interviewed the customer? Where the founders come from? Do they really have what's needed to pull this off, right? And have we done enough diligence on the competitor side? Are there any smaller company we kind of, not in the PitchBook or Crunchbase or anywhere you can find, but there's small companies out there that have actually kind of start to compete as well in the market. So yeah, many different angles that we poke around in a deal, right? We don't need 100% consensus because we did find that some of the best deals that we made or best investment we made didn't come from consensus kind of outcome. Meaning that, every partner agrees on the deal, that doesn't necessarily mean it's the best investment outcome. Oftentimes, it is the founder who are controversial, who bring interesting, kind of crazy, interesting ideas, eventually become a gigantic success, right? So we respect that. So at the end of the day, we only need actually, so we have 4 final voting members. The 4 voting members, as long as we don't have actually more than 2 on the vote downs, then we can pass. So as long as we have 2 people who actually agrees to fund the deal, and the deal will go through.
Do you remember any kind of deal where you were fighting for some deal?
I keep coming back to Zoom because that's the most well-known deal. But
so you've been engaged in that deal?
I wasn't personally, because that was actually made even before I joined the firm. But I can tell you that deal was actually, I think, only 2 yes votes.
2 yes? So the minimum.
The minimum. Yeah. So I think I joined the firm I think a couple of years ago after my time at Propellex, and as far as I can understand, every single deal that I pushed that invested was not without huge amount of argument. I can't remember there was a deal that was really all the partners said yes. I think at least there's one partner who says, no, I'm not comfortable voting yes. That tells you, first of all, we respect their diverse opinions. That doesn't mean everyone has to be on the same side of the boat to convince you that it's a good deal to invest. Second of all, there's always rigorous communications and argument within the firm to poke around to see whether you have the gut to stand to your own opinion. Let's say I propose a deal, I have to stand behind it. So no matter how many partners are saying that no, I don't like the idea. This is why. You have to present your ideas. You present your due diligence that you have done to say no. I think this is a good investment, and I disagree with you with what you think. And this is the evidence why I think that way, right? So it is actually the most interesting part of, I would say, investing is that even though there's confrontations, but that tests how much of a work you have done in make that investment, how much you know about the founder and the company, the technology, the market, to be able to kind of to push forward, to push back on different opinions, and to convince them that this isn't a good idea.
So first, founder needs to convince you, and then you need to convince the investment committee.
That's why we spend a lot of time with founders.
Yeah. How many meetings do you have prior to this investment committee, and do you invite founders also to that meeting?
Of course, it depends on deal dynamics. Unfortunately, sometimes there are companies that you really like and things moving a little faster. So you do want to actually kind of just crunch that meeting frequency as close as together as possible. Typically, I think for most of the companies, we're not a fund that's chasing hot deals. We'd rather have enough time to due diligence the company than say, well, oh, you have all the investor lined up, so we have to quickly send you a check without performing thorough diligence. We always do, but let's say typically it takes a month to come to the conclusion. We might take, let's say, a week or maybe 2 weeks to come to the conclusion, but we still need to check every single box to make that happen. That means if a deal is actually fast-paced, then we have to kind of spend more time or have more meetings in the near future rather than just space out the meetings. I would say typically we start with, let's say, either a Zoom if they're out of the Bay Area. If it's inside the Bay Area, we typically want to have a first meeting, which is in person, maybe a 30-minute meeting. It can be a coffee shop or it can be in our office, and they come to our office. And the final meeting is always in office, and we wanted to have the founding team. And typically, every one of the founding team to come in. We want to see the founders' dynamic as well. And oftentimes we do
founders' dynamics, how to
present, how they talk to each other, and that's very important. Oftentimes, because we invest in deep tech, and there's always a physical kind of product, and we wanted to actually see for our own eyes. If it's software, it's okay. You can see actually through the online demo. But if it's a physical product, you wanted to see and feel for your own purposes, and because oftentimes it can be faked, right? So we want to see that, and also see how founder actually interact with the product. And sometimes you can see their passion. They want to be hands-on, even though that person might not be technical. But you want to be hands-on. You can tell that how passionate he is about the problem he's trying to solve.
Are you trying to challenge them somehow as well and see how do they?
We always do.
Yeah?
Always do, and see how they actually respond to tough questions. And our questions might not be right, honestly, because we're not the experts, right? Sometimes. But we poke that question because we want to see his feedback. And oftentimes we tap into the psychology of the founder as well. That's why we spend a lot of time with the founder. Sometimes even invite them to our house or invite to a dinner table or whatever, a restaurant. We want to see how they think about these things and how do they actually look like growing up. And because sometimes there's this founder psychology, and we actually kind of identify some of the founders that might have that traits. And that's that found very early on, right? So you want to dig as deeper as possible for that founder's personality and founder traits.
How much time do you spend advising startups?
Oh man, I would say probably never enough. You want to spend more time because I enjoy doing that, working with founders. The best feeling is actually investing in a smaller early stage company, eventually to see them go public or become very big successful company. That fulfills why you want to be an investor. But I would say probably only 10-20% of my time is really kind of actively advising founders, either founders that we haven't invested and they're early and they're in incubator, or founders that we have invested and you wanted to actually also help them as a portfolio company. So I would combine them together. I would say probably 20-25%. This does not include all the introductions you make. And those are kind of additional, but when you actively talk to them, I think it was probably 20-25% of the time.
When you do introductions for them, what are these introductions about? Are you looking for other advisors, or maybe you think that some of your friends can back that startups? What is the main topic?
Yeah, so depending on the type of companies, right? If it's a company that's incubator or even pre-incubator type of company, too early, I typically do introduce them to people who can help them to be a fundable company. So for example, you do look for someone to be a product guy. You don't have you want to build a product, but you don't have engineers product. You do connect them with that kind of talents, right? Or if they're not venture fundable, but they could potentially be angel fundable, so I introduce them to angel investors. It's really whatever is stage or company appropriate, right? So, and also when it's a company that's ready to sell something, you connect with their potential customers. Or as I said, their product might not be ready, but they need to, especially the deep tech companies, they need to work with larger companies to be a design partner, to be a pilot customer, and then you introduce the Fortune 500 companies to them. So it really depends on what type of resource or connections they have. We do all sorts of connections. Yeah.
You should have a lot of communication in your work every day, connecting founders, making your own due diligence.
Yeah.
And then you should probably also ask for the feedback when you connect both parties. Yeah. Mm-hmm. You need to spend another time to get the feedback.
Yeah.
And
so on the feedback side, I would say, depending on the areas that we're investing in, for some areas, I think at TSV are, I would say, one of the domain experts. As I said, in a lot of deep tech area, in robotics, in parts of the robotics, in cybersecurity, in especially AI-related cybersecurity, as well as I think in things like energy-related semiconductors. Because the founder's background, because the partner's background, I think we are the ones people tap into us to diligence the company. I think it's typically the ones that we're not necessarily domain expertise. We don't have the domain expertise. We will probably tap into other partner VCs and to say, well, take a look. And then we act at your feedback. We don't necessarily have to listen to other people's feedback to make decision, right? Especially in the areas that we are pretty convinced that we are good at that. So we typically make our own judgment. But when it comes to areas outside our expertise, well, we really like the founder. But that market, the product, we're not exactly sure, and we're tapping into some of our ecosystem partners and to listen to their feedbacks. I think customers, yes, especially when we have a company that we haven't invested yet, and we do have a strategic that we know, and we tap into them sometimes to say, well, if you have such a product, are you going to use it? At least try piloting with them. If after their conversation, the feedback is positive, and that's always a good sign, right? I think customer feedback is, I think feedbacks, and then sometimes we do reference calls to understand the founders. As I said, we place a lot of emphasis on the founders, right? We wanted to know, sometimes the back channel, to know what that person looked like, right? And for people who have worked with them, but we don't necessarily trust the references the founder give us. The founder might give you a couple references, they're always good, right? You want to do back channeling. So that feedback is also important to understand, what they really look like, behind the scenes, right? Yeah, so a lot of communication for sure. I think VC is actually, well, you other than making investments and advising founders, helping them make connections, getting resources. On the other side, we also fundraising for ourselves as well. So there's definitely a lot of communication on both sides of the table.
Mm-hmm. How does it work with a Skydeck? So do they usually provide you with founders, or you choose what kind of what founders are you going to work with?
Skydeck is very organized, very good, well organized, I think, incubation or acceleration program. So every year you do have the application period. So we do receive, I think, if not thousands, I think close to 1,000 application, and you have to narrow it down to a number of programs. So there is a main program which is Skydeck, kind of regular sort of accelerator batch. So there are the kind of accelerator cohort, and there's also like I think they call pad 13, which is like a companies that are not ready to go into accelerator, but otherwise are good quality, and we wanted to actually preserve it for maybe future batches. So there's these tiered kind of companies you wanted to keep it within your ecosystem, right? And out of the applications, let's say 1,000 applications you receive for every single batch, and then all the advisors will go in and to volunteer for screening the opportunity.
Wow, really?
Not everyone would do that, but there's always a large number of, I think, I don't know exactly how many, 20, 30 judges will go in and actually filter these companies. And eventually it goes down to maybe, I think, a small handful of companies. And then we look at kind of the scores. And in each of the company, we also give our comment as well. Like, why do we think that's a good company? Or why do we give a 4, not a 5 in that category? And you do have to write up your narratives. So there's a lot of work. So not everyone is looking at every company, but each of the company would have some people who are really domain experts in that area to score it and also to comment on each of the scores that give.
Right. Wow.
Yeah.
I didn't know that. So you engaged into the process of selection.
Yeah, it's a lot of work, honestly. But I do that as my spare time. It's fun.
Okay.
To look through different companies.
So, and it depends how much time are you willing to invest into that. And when it comes to for startup advising, so how many you take from the batch that you actually can give?
So last year, this most recent batch, I wasn't as closely involved because there were a number of things that I'm doing at the TSV I would not kind of go into. So that's actually added to my bandwidth. But last year, I think I advised 5 companies.
5 companies.
5 companies, yeah. There are different levels of engagement. I think each company would have a key advisor, 1 or 2 key advisor, meaning that these people will spend a lot more time. So I would say most of the key advisors are almost like not full-time or part-time. They spend tons of time on the company. But then there are advisors who the company want involved as an advisor. I'm a lot more like sort of advisor, not a key advisor. Key advisor meaning that you have to spend like 20 hours or 10 hours a month, something like or a week with the company. There's a lot of work.
With the company, with one company?
With one company, yeah.
Oh, wow.
So a lot of work. So that's why I'm thinking that the incubation program is very well structured and resource provided as well. So for me, it's basically you have these conversations with the company, and they do interview process, right? There's a lot of interviews that the founders have to go through to find their right advisors, and the same process happens with advisors as well. So it's a kind of a bilateral kind of relationship. So you actually tell the incubator what are the founders you want to advise, and the founder tell the incubators what are the advisors they want to work with. And oftentimes, I think there is this structured way of doing it, and to find the key advisors, but also there are a little less structured way of doing it, meaning that the founders might want to work with Lisheng, and because we had this conversation, and they think, Lisheng, I want to get involved in giving that advice, and can we actually have like a 1 hour or 2 hour of your time a month? So that's actually sometimes it's outside the system, and I'm happy to provide that as well. So these are different ways of kind of matching up the founders and advisors.
Another question is, you have some introduction. So for how long is your first call? How many conversations do you usually have? What do you expect to hear on the first call? So you were introduced through accelerator or some founder, and you are going to have a first call, a first meeting. with the founders.
Yeah.
So how much time do you schedule, you plan for this first meeting, and what do you expect to hear in order to have another meetings?
So honestly, many of the founders I met, I've already kind of gone through the screening process with Skydeck or whatever. So I've know what they do, and they might have updated deck, but by and large, in the same direction, same product.
So before the first meeting, you already know.
I already know
and
quite a
ready.
bit of the company, yeah. And because I've not spoken with them, but I've gone through their applications to know them enough, right? But even for companies I've not spoken with, I will probably at least spend 10 minutes on their deck. I might not go super deep into the markets and stuff like that. I want the founder to be able to tell me what the market, how do they think about the market. I don't want to have a too deep of understanding of that matter. I want the founder to tell me as a layman, right? Someone who look in from outside, who doesn't know the space, to be able to convince me. I feel that's a very useful skill. And after the call, I would actually do more research. If that founder interests me a lot, I would actually do more research and to qualify his or her comments or claims. And sometimes you do see that claims and comments are very, very far from reality. And that's also kind of sometimes could be a potential alarming sign. Really, have you put enough thoughts into it? I mean, is that the reality, right? And then I would actually use this as my question to email back to the founders. Of course, the founders have to be super strong and attractive to me. If the founder is not interesting, and then he or she over-exaggerate the problem, I probably wouldn't even. I would probably say, well, I mean, I don't think that's reasonable, but not too much into it. But if the founders are interesting, and there were these questions I have, I will probably do more research and then get back to that person and to say that I think this might not be right. Have you thought about this? And this is the evidence I have, and that actually sometimes give you more credibility. So founder will look back and say, well, doesn't matter you're right or wrong, you spend time on that, and they respect that. And oftentimes you hear that, oh, Lisheng, you have done way more research and you understand this market way better than even the lead investor, and therefore I want you to actually be involved in the company. Or can I, are you interested in investing? Maybe my round is oversubscribed or fully subscribed, but I want you to write a check. I still want you to be around. Or maybe you involved as an advisor. So I feel any effort you put into these smaller things, don't overlook it. It could come back to benefit you.
And when you do your research, what you usually check?
I check competitive intelligence.
So you work with a deck. So you should have a deck, yes?
You should have a deck, definitely. Well, honestly, it depends.
Sometimes executive summary is enough?
No, sometimes I take calls without knowing much of, just because of founder. Just because, Vasil told me that there's a founder I should meet. And roughly, he's doing a robotic arm. And that's it. That's all I know.
Okay.
I go into the meeting because we want to respect the founder as well, because sometimes founders don't want to show too much to a stranger. Right? If I do have kind of technology I'm still working on in a stealth mode, I don't know how much I want to tell you. I mean, I don't even know you, right? But then through that connection, we get on the first call, we can just chat as we do now. But that gives me a lot of information about that person and also the product and company. I don't even need a deck. But that conversation could get me really, really interested. Sometimes we invested, maybe the founder doesn't have a deck or have a really, really ugly or preliminary deck. But to a person who doesn't necessarily have the connection to Silicon Valley, you don't have Vasil to make an introduction to Lisheng, you better have a deck or at least a one-pager.
Yeah.
Right.
Yeah. Okay. Thank you very much. I think we need to cross the line for today because we can talk for much longer. Thank you very much for joining us today. Really appreciate your insights and everything you shared with us. I hope it will help a lot of founders in order to prepare how to negotiate, how to get in touch with investors. The real mission of this channel is to share a little bit more about this. How do we see things from here, from Silicon Valley? So thank you again for your time, and hope to see you again in our interview later.
Thank you very much for inviting me. This is fun. Let's do it again.